Hi everyone. I think
Yeah, hi everyone. Welcome to this AMA from Omniscience Capital. Uh, so let me do a quick intro and then we'll get on with the AMA. Myself, Ashwini Shami. I'm part of the founding team of Omniscience Capital. And with me, there's Dr. Vikas Gupta, who is the architect and behind the scientific investing framework and is founder of Omniscience Capital. And happy to be here. And I think let's get started with the discussion, Vikas. And the title that I wanted to give to this AMA specifically, just to keep it little relevant about the current time, is to talk about more. We are at an all-time high, or all-time peaks when it comes to the broadline indices or Nifty, going very close to 21,000 it touched, and it didn't close beyond that, but it touched yesterday, the last trading session. BSC Sensex is hovering around 70,000. It's just about to touch that. So clearly these are all-time high numbers, and very exciting times for investors who have taken positions, and invested significant amount of capital on equities. So they are definitely making some money. But at the same time, the jitters start coming in that because it has hit sometime something like an all-time high. Is there a chance that there is a correction which is going to come, and is the markets are overvalued, or markets are at crazy heights, and is there a lot of liquidity flowing in, or there's a lot of euphoria, whatever, and people try to build scenarios that why they have to be pessimistic about the future. I think, and it's very important that we as in equity investors are absolutely confident and clear about what we are doing, how we are seeing things in a very very analytical and very very objective manner. So I think let's start with there, and how do you want to address that, the all time high kind of jitters?
yeah. So I mean, market is all-time high. In fact, Sensex, the normal Sensex, which we are all familiar with, is close to 70,000, as you said. But the real Sensex, which is Sensex Total Return Index, is actually more than 100,000, 1 lakh. Okay, so that is a Sensex which includes the dividends. Okay,
Right.
so and investors when they buy stocks, they of course some dividends as
I think there was an
what
issue
that
with
means is that someone who invests time is sitting.
there was some
There's some sound
connectivity
issue.
issue, because
Hello,
if you could just
can you hear
repeat
me?
the last sentence.
Yeah, so I was just saying that uh, someone who invested in 1979 is sitting on 1,000 times if he stayed with
Right.
Sensex, including the dividends. So Sensex
Correct.
is 1,000 times, and sure, so all this is great, but also understand even though it is all-time high, our GDP is also all-time high. Okay. So it is not that just market is moving and there is no economic activity underlying that. So first, the economic activity is moving. So we were something probably like 150 billion at the time of GDP at the time of 1979 when Sensex started. Today we are sitting on just short of 4 trillion probably, right? Depending on whose estimates you see, it's somewhere between 3.5 to 4 trillion. So markets have been moving, but economic activity has been driving it. Okay, so that is something which we need to understand. Economic activity, as in GDP, which is based on the revenues and profits of the companies. So all of that is moving together, and that's how we are sitting here. And of course, the interest rates matter in terms of what level or prices in the market should be, right? And even there, the expectation is of the interest rates going down from where they are artificially high, at least in the dollar terms, right? In the rupee terms, you could argue they're slightly high, but in dollar terms, they're extremely high. So when that normalizes, what kind of market levels you should expect is where we are started to move towards. My point is that all-time highs, we should not confuse it with bubble. Okay, bubble is a separate thing that can happen, independently of all-time highs. So every all-time high need not be bubble. Usually, yes, every bubble is an all-time high.
Correct. Right.
Right. Right.
Absolutely. And I think, if you just look at few numbers in terms of the multiples, right? So Nifty 50, I was just looking, Nifty 50, Nifty 500, they are in the range of 22 point something, 23 point something, right? So that even on a historical basis, it's not crazy. In terms of, if you don't go by the historical number, just look at the basic fundamentals and look at what is the kind of earnings yield that 22 p translates to, and at the kind of a growth outlook that the economy has. It is definitely not a crazy valuation. You are getting a reasonably healthy, around like a 4 to 5% kind of earnings yield, and you are getting a good, potentially double digit growth number, right? So I think that's going to be a very attractive place to be, going forward.
Let's just do a quick estimation of the nominal GDP growth, right?
Right.
So 7% just now, yesterday, RBI also confirmed, and that's the kind of number we're talking about, right? Real GDP.
Right.
Plus inflation is somewhere around 5%. So roughly around 12% is what we are talking about, is the nominal GDP growth rate, right? Going forward, the growth rates should be even higher. So 7 should tend to 7.5 or even 8% on the longer term basis. Inflation should trend down to 4%, right?
Correct.
So it's again somewhere around 11.5 to 12% is the nominal GDP growth rate. Listed companies are typically faster growing, right? Because the whole GDP includes agriculture, etc., which is slow growing, and unorganized services, which are slow growing. So manufacturing and organized services will be much faster growing. So we should have something like 13-14% growth rate, or even 15% growth rate on the listed firms' revenues, right? And then revenues, of course, earnings can grow faster or slower for some time, but on a longer run basis, they should track the revenue growth, right? On an averaged out basis. So somewhere between 13-14% is what we are talking about on the market over the long term, nominally.
Right.
So given that kind of growth opportunity, number one,
Right.
and then the yield, as you mentioned, is somewhere between 4 to 5%.
Yes.
If it was
And
25
in
P
fact,
also, it is still 4%. Yeah.
on that earnings bit, if we look at the current ROE, the current price to book, what is reported and what the PE number, and you deduce the ROE number, that is coming around 16. Okay, 16%.
16. Okay.
So that's also, I would say, that's need a lot of normalization, because that is not the long run average ROE for the Indian economy per se, right? Given how you built up the kind of return expectation on an equity investment or an equity investment by the companies, they typically will not be happy at a 15-16% ROE, right? So it's typically higher, right? And in when the economic boom or like economic conditions are flourishing, then we have seen it going to as high as like 25-26% number as well, right?
Correct.
So let's say if you are, a normalized number is somewhere closer to, like, for the Nifty 50 companies, like which have the, overall they have, competence and kind of persistent advantages, which gives them a higher ROE. It should be closer to 18 to 20%, or
Correct.
slightly higher. That means even if I just normalize the earnings, even this PE is, will move downward, right? So that's
Yes.
another way to look
Yes.
at that. It's not crazy overvaluation by any
Correct.
stretch.
Correct. Yeah. So normalized earnings is very important, what you just mentioned, and which means also look at normalized ROEs. And clearly see, finance or banks are basically around 30% of Nifty. And if you look at the ROEs there, they are ranging from single digit to 13-14% right now, while they should be somewhere closer to 18%.
Right.
So if you normalize even just for that, you will realize that the stated earnings are significantly understated. And the real true PE is probably below 20.
Right.
I mean, this is all at the market level, right? Now,
Correct.
you want to look further down, of course, mid cap PE is slightly higher than or
Yes.
similar to Nifty PE, and the small cap PE is much
Is
higher, right?
even higher, right?
Yeah. So definitely you should worry about frauds in the small cap space. Okay. Definitely you should worry. But um, the fact that is there an opportunity, you could just look at, Omni small cap, right? Omni Supertron small cap PE. That's somewhere around 20 compared to the benchmark small cap PE being closer to 30, 29 or
Yes.
30.
Yes.
So that just shows that it's possible to create a portfolio which is significantly undervalued compared to the market. But yes, blindly buying the market is probably not a great strategy anymore.
Right.
Okay. And
So we will talk about, what is the kind of a, model allocation, or, how do you go about allocating any further capital, or, whatever invested capital is also, is it at the right place? That is one discussion that, viewers might be interested in. But before that, let's just talk couple of more points on the growth outlook that we talked about, right? So basis was the GDP current growth, and and the long term inflation numbers and how they are going to stack up. But we are seeing a lot of interesting numbers on the investment side, right? Which is
Mhm.
like building the fresh capex and building the fresh manufacturing capabilities.
True.
Yeah, the credit uptake is growing at 15% and more. The in fact, in the GDP number itself, the the capex investments part of that grew at around 11%, right? So that's faster than the GDP growth itself, but it is like providing resources for future growth, right? For the next
Mhm.
many quarters of growth that is going to come, right? This and in terms of I would say like the private sector balance sheet has got delevered significantly after the COVID, right?
Mhm.
We
Mhm.
are something like a 7.7 debt to equity, or zero point 0.6 net debt to equity numbers, which typically remains at one, or it goes up to as high as 1.5 in the past, when there is a lot of confidence in putting up the expansion plans in place, and then they are happy to raise a lot of debt. And so even the interest coverage numbers, if you look at, they are nearly all time high, for the whole
Sure.
economy, like for Nifty 500 or Nifty 50 companies, I'm
Sure.
saying. So they feel much like the private sector will feel comfortable in going out raising more debt if they see demand, if they see, and which is what we are seeing from the GDP growth numbers, that demand will be sustained
Absolutely.
with these growth numbers, right? And GST collection, like if you see, they are at all time high, right, and growing in double
Absolutely.
digit consistently.
Yes.
So I think that builds up the growth scenario, or rather the demand scenario, that the economic activity is tangible and it is there, it's real. Plus, the investments coming from the public sector or the government side, and what is coming from the private sector, in terms of now people are ready to re-lever their balance sheets, and prep themselves for the growth that is going to come, or the demand that is going to come. So that also kind of reinforces that the economic growth should sustain, and for a rather longer time than just being a blip in a quarter or two, right? So
No, absolutely, absolutely. And if you look at the kind of capex being done on infrastructure, that's
yes,
a trigger for very long-term growth, right? Infrastructure immediately, of course, it is driving growth because people are buying cement, steel, whatever services for executing those projects, right?
right,
But then once those, let's say, a highway is available between Mumbai and Delhi, which is extremely fast, that's going to trigger more economic growth, right? Let's say a dedicated freight corridor between Delhi and Mumbai, or Delhi and Kolkata is available. That's going to create a permanent upswing in economic activity, right? So that's the kind of capex getting done, and that's going to trigger a higher uh, level of growth permanently in future or for the long term. In the short term, of course, we are seeing, I mean, even the automobile sales numbers, etc., which came out, right? That
Yeah.
consumer demand is also getting stronger. So with consumer demand as well as government spending, the private sector is going to feel confident to invest a lot. And as you just pointed out, the balance sheets are very clean and highly delivered. Same way, the balance sheets of the banks are also extremely clean now after
Right.
all the cleanup. And they are ready to now power the growth, right? And then lend to the government or private or even the consumer sector. So this is a very interesting inflection point, I would say, where the economy is. Secondly, with US Fed, you know, likely to start cutting rates very soon, the flow of money from the global markets to Indian markets is also another thing which is going to happen. I'm not talking FII, I'm talking FDI first, right? Driving for the long-term growth of India and trying to benefit from that. And then FI follows as a result of expected growth.
Correct. Correct. So, absolutely. So I think the next bit that I wanted to, kind of talk about, because is, yeah, is the real question that, how do I allocate here, right? Or what do I do with the money, or are my
Sure.
investment, allocations so far, are they
Sure.
in good place? Are they, in terms of all-time high numbers? Is there
Mhm.
something I need to do? Right? So
Sure.
typically our philosophy is, we don't do tactical allocations, right? When
Right.
it comes to equities, we are in for long term, right? Our
Right.
allocations, our model allocations, recommendations, whether it is a kind of a thematic or a growth vector driven investment or a core investment, it's typically all long term, 3 to 5 year kind of a scenario, right?
Correct.
So how do you look at, is the model mix, or maybe you can talk about the model portfolio itself, across, which typically is suitable even for a conservative to aggressive, with some tweaks in the percentages, but all kinds of risk profiles is caters to. But do you see any changes in the model portfolio allocations, given that what current market numbers we are at, the headline
No,
numbers?
yeah, I mean, see, you of course, we follow the scientific investing framework, right? And from the full market, let's say the 1,000 largest companies, or depending on what we are talking about. Right now, I'm talking about the flexi cap strategy, right, which chooses from the 1,000 largest companies and creates a broadly focused but diversified portfolio, right? So there we are going through the full market and taking out the junk companies, taking out the weak companies, taking out companies which are not don't have persistent competitive advantages, etc. Weeding out all of this, and then you're left with two groups, which are practically all are good companies. Many of them are great companies, but you need to now slice and dice and see which are priced properly, right? So as we always say, great company is not a great investment necessarily. At some point of time, at the right price, a great company is a great investment. Rest of the time, a great company completely overvalued is a very, very bad investment. And that people have experienced over the last 2 years, right? Some uh, portfolios or some companies which were very popular as great companies, they remain great companies, but the portfolios have severely underperformed. And because of PE derating, right? If you buy something which is above 50 plus PE, you are going to face trouble eventually, right? So our philosophy is, I mean, of course, it's not PE is the end result. You have to look at discount to intrinsic value. But using the scientific investing framework, basically we create a diversified pool of a portfolio of companies, right? But it's not just stock level diversification, it's not just sector level diversification, it is what we call the growth vector diversification, right? So you create a portfolio of various growth vectors. So if you look at what the result of that is something like a 16 PE today compared to market PE of 22, 23. So it is possible to create a portfolio of some of the fastest growing companies, or at least a portfolio of companies which are growing much faster than the average economy or the average listed company, right? While they are available at a significantly lower valuation, at significant discount to intrinsic value. So I would position Again, this cannot be a recommendation, right? This is a live interaction. So there can be no recommendation. That people should be clear. Of course, equity markets are extremely risky. So please understand all those things. But within that limitation, broadly, what I'm saying is, let's say I had 100 rupees, I would be putting somewhere between 40 to 60 rupees in my core portfolios. Okay. And within the core, again, we have 4, 5 things available, right? And then we will talk about the satellite portfolio, which will boost the core further. But the core portfolio, even at this point of time, as I mentioned, it's at 16 PE, etc. There are 3, 4 options. So there is Omni Flexi Cap, which is the Flexi Cap, which doesn't care about large, mid, small. But it's got 25 plus companies. Today, it's probably more like 35 plus companies, right? But eventually, it will go down to 25. So that's our long-term minimum in that portfolio. So that is the primary portfolio. But right now, there is opportunity even in global markets, right? So we have created something called Omni Super Global. That is another way where now you're getting diversified across countries, okay, developed as well as in Indian markets. So that is something depending on how stable you want your portfolio to be. That makes the portfolio a little bit more stable. People who are more conservative, then we have Omni Super Assets, right, which has multiple assets in there, including fixed income. So there are all these, and that I cannot talk about all of them. There are about 6 core portfolios which we offer, right, including, let's say, Omni large caps, Royals, right. So depending on what people feel, they can pick and choose their core portfolio accordingly, and then boost it with. So you build the portfolio with this, and then boost it with what we call the growth factors, right? Things like Omni Power or Omni Capital Enablers. So these are providing exposure to different growth vectors. So maybe you can elaborate a little bit on what kind of growth vector opportunities you prefer, and
Sure.
how people can consider.
Sure. So there are certain questions also that have come, because so I would
Okay,
start taking those as well. And while we
sure.
are talking about, generally about the markets and our offerings, so specifically this question is quite common. Like, which small cases could I invest at this time? And looking at whether it is SIP or a lump sum. Amit Patel has asked this question, and I think it's a very common question in minds of all various investors, and specifically because we have a large number of offerings, right? Typically, there is one or
Yes.
two offerings, so it's easier to pick and choose. And that's where we thought that laying down the concept of allocation in our scheme of things is extremely important. That you just explained the core allocation, right? So every investor, now whether you are aggressive or a conservative investor, depending on your financial assets, like 100 rupees you put, whether 25 rupees you're comfortable putting 25 rupees in equities, or 80 rupees in equities, depending on your goals
Risk
and
profile.
your risk profile and your risk assessment. But whatever that equity amount is that you are going to put, that money that you're going to put in equities, is something that we believe it is a very structured way to go about it. It's not about, okay, I like this particular theme now, or this particular concept, or this market timing is good, so I'll get in now, and now I'll book some profits and get out 3 months down the line. This is not something that we cannot tell, frankly, and we believe nobody can kind of really predict it. You can only do it in hindsight, and will say that, okay, you should have invested at this date and exited here. But to take care of that, like, what is the scientific approach or solution to this whole kind of confusion, and what to do and what not to do, is you figure out your 100 rupees of equities, you put 40 to 60% into core assets, core strategies. Now, core strategies are typically the all-time, like, they are permanent strategy, right? So it's a large cap
Correct.
allocation, it's a multi-cap or a flexi cap allocation, which is always going to remain, because there will always be a large cap in Nifty, and there will always be a small cap, right? But obviously it
Mhm.
will go overvalued and it will go undervalued, and you might tweak allocations there. And
Correct.
and obviously in that whole small cap or a large cap, as Vikas said, that you can carve out a subset, because you only want to invest in, let's say, 10, 15, 20, 30 companies out of the full 200 or 500 companies. So you can always always carve out a subset which is undervalued, which is fundamentally stronger, which is exposed to strong growth vectors, and that will become your permanent portfolio, and you keep reviewing and rebalancing, which is our job, typically. But
Right.
that's what you need to be aware that, yes, what is my allocation in small cap, how it is looking at, what the PE numbers, what the valuations are looking at, and so on. So clearly, because there are other questions, so there is a lot of interest, and kind of people are trying to figure out that are mid cap and small cap overvalued, or the market, that these two segments have run up more than the large caps. Are they in a bubble territory, right? So relative
Okay.
valuation you talked about, definitely it is significantly ahead of, where, let's say, Nifty 50 is. If Nifty 50 is around 22, 23, mid cap is closer to 25, 26, and small cap is 28 or 30, right? So they
Yes.
are definitely ahead in terms of valuations, and because of
True.
what we've seen in the performance. So yes, there is more opportunity relatively in a large cap space as we speak, so that you can take care of in terms of how you go about allocating. So the coming back to the core question that, okay, which small case to buy, is a set of 40 to 60% allocation should go to your core allocation, which is like a flexi cap or a large mid small that are there, from us or maybe from other managers. But and the remaining, uh, let's say 40 to 60, should go to thematic opportunities, or the growth factors that we call them, because they are beyond what a thematic opportunity can give you, right? So that's a separate discussion, but obviously we'll invite you for understanding the growth vectors, investing in a deeper way sometime later. But for now, there are growth vectors like defense or railways or power or digital transformation or banking on growth, and so on and so forth. So there are various growth vectors exposed to strong growth momentum in next many years or decades, and available at very attractive valuation, because we believe that Mr. Market has not identified these growth vectors properly. And once they are being identified clearly, there's a time that you have to look at the next growth factor, right? So whatever is there right now that we are offering, we believe is attractively priced, okay, and you can continue to allocate to these. The point is that you should have a like a diversification even at the growth vector allocation. Like it's speculative in in our mind to just have one exposure in a growth vector as well, right? If you are doing
Yeah, I mean, just to give an example, like you could have Omni Super Stocks Flexi Cap as, let's say, 50% of your portfolio, right? I mean, it's how to think about it is what I'm saying. This is not a recommendation.
yes,
And now you have 50% remaining, and I could choose five growth vectors and do 10% each in those. So, for example, I could have Omni Power as 10%. I could have Omni Capital Enablers as 10%. I could have Omni AI Tech Global or Omni DX as nearly 20%, because that's a stronger theme and much longer lasting theme, right? Growth vector, which is basically, focusing on the digital transformation and AI revolution, which is going to disrupt all other sectors. So in
correct.
some sense, it's more closer to a core allocation, right? You want to be on the disruptor companies rather than the disruptee, getting disruptee companies. So so you could do 10, 10, 10, something like that, or something. If you could pick either capital enablers or Omni Bank on Bharat, right? Uh, or you could mix all of them and buy Omni FinTech, for example, where there is exposure to finance as well as to technology. So you are exposed to the digital transformation as well as you're exposed to the financial side of it. So there are all these, or you could add Omni Bullet Train as the, get exposure to the railways and logistics, capex investing by the government, right? So have something like 3 to 5 growth vectors or thematics, and at the core have like a 50% allocation to the flexi cap or one of the core portfolios from us.
Correct. So great. I think that kind of take care of, to give a view about how you can go about allocating for the capital from here. And you should take a structured approach. You should have a good allocation on, like, you can't be totally allocated just to growth vectors or few themes, and then it's risky because of exposure to a limited set of companies in that case. But one other question that has come, Vikas, from Sudeep George, is that his investments are up 35 to 40% this year, right? So he's asking that it is time to book profits and wait for markets to fall, or more upside is expected from here. And should he reinvest into finance and IT from small cap and other sectors? So,
Yeah, see, then it depends on which small cap we are talking about. If it is Omni small cap, it is very different, right? As I mentioned, it's a 20 PE, so I am very confident of this portfolio. Now you were talking of the typical company in the market that's extremely overvalued, right? In small caps. So I would book profits if it was something else, not from Omniscience. Of course, there can be again some other portfolio which is undervalued, and that you will have to evaluate. Looking, at least look at the PE. Okay, anything above a 40 PE, 35 PE, I would be, looking at exiting that unless you are confident that the normalized earnings are different, right? So that is something which I would like to point out. I don't think we addressed that at the beginning itself, that all-time high markets doesn't mean that we are in bubble. Secondly, by citing the PE of various portfolios, my point was that there are significant opportunities still available in the market. Third, the Fed is likely to start cutting rates. Now, whether they cut rates in next month or two, or starting from March or starting from May, etc., that all is a point of debate. Even Jerome Powell doesn't know because they do that meeting by meeting based on specific data. But that second half of 2024, are you going to be having rate cuts? It's practically, nobody will argue that it won't happen. And when that happens, money is going to flow into rest of the world, right? Into equity markets, into emerging markets. When money flows into it, it has to go to liquid large companies, right? And once those liquid large companies are, are already identified by FIs, then they have to move to the mid and small caps. So this is the kind of thing. Secondly, our own government is, had a good budget last year, and that all of that is going to be spent this year, and most likely to go over budget, given that it's an election year, number one, and even more important, that it's end of 10 years of term by the present government, right? So it's just think of the government like a management of a company, and you have a 10-year term, 2 terms. You would like to demonstrate a lot of completed visible projects. So all of that spending is expected to happen in the remaining part of the year, right, before the election, so that a lot of visible progress is there on the ground. Whatever they have been working on, as far as possible, make it reach the nearest visible milestone. From that angle, again, I expect that earnings and revenues will be very good. And third, if Fed is cutting, RBI is going to cut. Okay. Because RBI won't want rupee to become unnecessarily strong compared to dollar, right? Rupee has to remain competitive so that our exports are competitive. So slightly depreciated is what is preferred by India. And now import is anyway not an issue. Oil import was the reason why you wanted a strong currency. Otherwise, rest of the things are supported, exports are supported by a slightly depreciating currency, right? So now again, oil import, etc., from Russia is there, from various other sources, and even in non-dollar terms. So that pressure on having a very strong rupee is gone. So RBI would be alert and vigilant enough that as soon as Fed cuts, RBI will try to cut. And the impact on the market is naturally on the upside when you cut, because the discount rates get cut. So the intrinsic value based on the new discount rates, lower numbers, is higher. So from all those point of views, so I mentioned, which is fundamentals, right? Earnings growth, GDP numbers, as well as from the discount rate. Both sides, the pressure is on the upside. Expectation is on the upside. And so it's definitely not the time to start thinking that I'll book profit and wait for a correction. I'm not saying corrections cannot happen; they can happen because of various other reasons. If there is a war somewhere, or some domestic factors like election results are not as per expectations, there can be temporary blip here and there. But despite all of that, the fundamental growth and the discount rates are going to be on the upside.
Yeah, and I think two specific sector that he touched upon, and I want to comment briefly on that, IT and financials or banking. IT definitely with the whole interest rate cut expectations in FY24, the narrative is going to change. So while people or companies or Fortune 500 were preparing for a impending recession and can be conservative on expenditure, they are also going to change their stance, which effectively in last 1 year translated to IT companies giving a conservative guidance, and then the growth slowing down, and because there were furloughs or postponements of certain projects or execution delays, timelines were getting stretched. I think all that will the reverse as the narrative goes back from recession worries to growth, which is already there, right? So the US
Yes,
Q3 grew by 5.2, right? It's crazy.
absolutely. Yes, for
It's
a US
amazing for a
developed economy, it's
right,
really high number,
right, right.
and
So
that's not nominal number. That's real
that's a
GDP. Yeah,
real growth
yeah.
for US economy. So growth is already there, and there's no fears or recessions. And I think once the rate cut is there, it is further going to support the economic view, higher consumption, and people will allocate further to IT spends to capture that market that is evolving in terms of various digital technologies that something like a Omni DX or gives exposure to. So that is a very, very attractive space. I believe we have a positive outlook, so to say. Uh,
Yes.
Obviously, we're not trying to predict any kind of price movement, but the fundamental view is quite strong and quite positive. In fact, at the street level, if you see various brokerages, because now that the guidance by the companies is given of like a single digit growth or a low growth, the FY24 numbers are like that. But if you, as soon as you go to FY25 or FY26, by the same analysts who are saying that this large cap IT, mid cap IT will grow at single digit or like 5%, 6%, suddenly starts growing at 12 to 15% or higher in
Yes.
a year's time, or now it is about a quarters, like after close the year FY24, you suddenly enter into a growth territory. So market will start repricing it. They don't want to be just jumping onto it because they want to wait and watch, or let the company start saying that okay, we are going to grow double digit and then we want to react or reprice it. But that is where you start taking positions and start allocating to capture that mispricing that you are getting because of whatever these specific anomalies that the market has. So that way is the we have a strong positive outlook. Banking and financial services, I think we already at the beginning we touched about that, the whole re-leveraging and the lot of infrastructure spending, and so all that is giving boost. The balance sheets have cleaned up in a significant way for the banks. That is helping to improve their earnings, ROEs, and so that adds up to their strength to grow from here, lend more, lend aggressively,
Hmm.
and
Hmm.
so on and so forth. and,
Absolutely.
and then the industry is whole geared up to kind of take a lot of credit, or allocate to capital building or capex, manufacturing setup and so on. So I think both the sectors are actually quite attractive. We have a positive outlook on both, and definitely because I address that, given the external economic factors and other scenarios, we don't believe there's a time to kind of start looking at profit booking, at least at this time.
Yeah, but
So
I completely agree with that finance and IT. Uh, Someone has pointed out that they are very attractive. And second part is finance is approximately 30% of the Nifty, and IT is roughly 10 to 15% of Nifty, right? So
right,
of Indian markets. And both are severely or quite undervalued, I would say, in our opinion, our analysis. And when the FII comes, these are the places where automatically their money is going to be deployed, right? Because they are significant presence in even in the top 10 companies of India. So that is going to unlock faster, I would think. As a thematic, I would focus on finance-based and IT-based thematics for sure. But even from a longer-term perspective, so forget the near term, longer term, like what we've been mentioning for years, probably first ones to mention that in India, that digital transformation is a multi-decadal opportunity, and the client companies in US or Europe have no option but to choose from probably, the majority of them being Indian companies, right? There are just 4 or 5 non-Indian companies which are large enough to do digital transformation, right? At a significant scale for these clients. Rest of them are all in India. So that has to be done. Secondly, AI revolution. Everyone is aware of Chat GPT, and people have been using or without even knowing sometimes AI. And that's just at the beginning, the kind of things AI can do. But then who will make it do? Again, it comes back to the Indian companies, Indian IT companies. So this is the reason why you need exposure on a longer term basis. Same way, banking is a monopolistic sector in India. I mean, shouldn't say monopoly, but like a oligopoly, like a handful of companies. Much fewer companies have the license compared to what is needed. So all the business of lending comes to these handful of companies. Those handful are still 20, 30 companies, but hardly 10 of them are very, very large, right? 5 to 7 of those are extremely large. And they are going to get that benefit of having oligopoly, right? Supply demand mismatch, and the high growth rate of India over the long term, expected long term, which will be which will be financed by these companies, right? So there is very clear reason to be in finance and IT.
Yeah. So moving on, I think we have few questions from Anirban. So Anirban, your understanding of Bharat Amritkal to be a core portfolio while defense being a thematic is absolutely on point. So Anirban asked that the PE of Bharat Defense is pretty elevated. Would you recommend us SIP or a lump sum investment for better value derivation?
Yeah, so we'll address that first. Like he mentioned that Amritkal is a core portfolio. Absolutely right. Omni Bharat Amritkal is a core portfolio with people having even a 25-year outlook can be in that portfolio, and the portfolio will keep changing, right, as opportunities change, fundamentally as well as from valuation perspective. Secondly, yes, defense is looking overvalued. Okay, the companies we have, but again, it's not as overvalued as it looks because the earnings are not normalized, right? The reported earnings for some of the companies are significantly below what the normal levels should be. These are all project type companies, right, which execute projects. So depending on if they complete a lot of projects, then a high earnings is reported in that year. And sometimes when there is work in progress on a project, then the revenues are not fully booked. Okay, because revenue booking also involves the client. Like the clients accept only on certain milestones that progress has happened, right? So it's linked to those kind of things. So there is a lot of lumpy behavior in terms of that. Sometimes they will report very high earnings and revenues. Sometimes they will report very low earnings and revenues. Right now, the reported earnings for a lot of those companies are lower than normal, I would say. So what looks like a very high PE is probably, I would still say it's an elevated PE. And we are looking closely at the portfolio. We are trying to identify some more companies which are undervalued, and we will be tweaking the portfolio. So uh, definitely, we are not saying that you get into lump sum investments in the defense portfolio right now, but we will be managing the portfolio to make it more tweaked to more undervaluation.
Absolutely. Great. So there is one more question, Vikas, from Sudeep again. Was to talk about what is the differentiation, like what is the advantage of going through our small case or small cases in general versus vis-a-vis mutual fund. So how do you?
Yeah, see, that's a tricky question. I cannot address it for all small cases. I can address it for our small cases. The reason to go to mutual funds is typically that SEBI regulates them heavily and puts a lot of constraints so that the investment money of retail investors, very small investors, is not at risk. The whole objective is to reduce the risk significantly by putting a lot of constraints or regulations, right? Now, the end result of that, the byproduct of that is that most of the mutual funds end up underperforming even the index, right? This is seen from the Spiva study from S&P Global, right? SPIVA. You can go and type SPIVA India in Google and you will get those reports, right? They're done twice a year in India, every 6 months. And in US markets, they're done 4 times a year. So Spiva study will show you how many mutual funds are outperforming or underperforming the index. Typically, anywhere between 60% to 90% underperformance is there vis-a-vis the index. And as you go longer term, means if you see 10-year underperformance, it's majority of the mutual funds will underperform. Okay. Uh, there's a little bit of outperformance or better performance, I would say lesser underperformance in the mid and small cap space. Okay, on the that too on a longer term, shorter term basis rather. As you go longer term, mutual funds tend to underperform. So they're safer. If you just want market exposure, you could look at that. But if you just want market exposure, you could even look at ETFs. Okay. Now fees part is, I think, similar. Mutual fund and small cases is broadly similar. Uh, uh, but sometimes mutual funds could be cheaper as well. But the reason to invest in a strategy or a portfolio is not for the fees, right? You can't just optimize for the fees. Yes, if I am investing in an ETF, then I should go for the lowest fees. If I am investing in a mutual fund and I'm saying I will go for the lower fees mutual fund because anyway they are going to underperform or be close to the market, then why are you even considering a mutual fund? Just go to ETF, right? So even in a mutual fund, if you are going to select someone, it's based on higher expected returns, right? Not based on the fee. That's not the correct criteria. We're talking of, I mean, long-term Nifty returns is something like 12, 13%. So better than that is 15% or so. So when you are talking of something in that range, how does it matter if someone is charging 0.5% less fees? Instead of 2.5, someone would be charging 2, someone would be charging 1.5. Is that 0.5% or 1% the real way to analyze? Or is the better way to focus on what is the investment philosophy of this portfolio and the fund manager? What is the investment process? Do I trust that to generate at least the market returns over the long run and do much better than the market, right? So that outperformance is anyway going to be much more, compared to the fees difference which you can expect.
Sure.
Yeah, so
So
I wouldn't select on fees.
yes, fees and then
And
the
yes,
investment
okay. My
philosophy
one more point
strategy.
I forgot.
Yeah,
Yeah, one
sure.
more point I forgot. We have launched large cap, mid cap, small cap, flexi cap, right? And dividend strategies. So to leave the dividend aside, but all of our large, mid, small, all of them have somewhere around 20 stocks, right? The flexi cap has more than 25 stocks as a rule. So we are focusing on similar safety constraints which SEBI is trying to put for mutual funds. It's not the same, but in our opinion, these are much uh, diligently designed portfolios in terms of diversification and so on, and the maximum allocation we allow.
Correct. So yes, so absolutely, because I think we always talk about this, that these are all different types of wrappers, but you are essentially investing in a portfolio of stocks. Now, a mutual
Exactly.
fund manager is selecting, or a PMS manager, or a small case manager or whoever is doing that, your end money goes into that portfolio, and how that portfolio is built, what is the philosophy behind that, and what is the approach behind that, and how well it is done, that is what determines your returns. And obviously you can't too much worry about the fee part, because that's not going to determine practically what is your long term, how compounding that is going to be. If you're just doing ETF, just chasing market, then definitely that's the only thing to look at actually. And people do get swayed into, what is a tracking error and what is this and what is that.
Correct.
Those are less important things, but just looking at the expense ratio is probably important. And yeah, so that is one thing, the investment philosophy, and how do invest with confidence, be very, very sure about what you are doing. And if you have a philosophy or a structure like a scientific approach and scientific investing framework kind of thing, then you feel much confident about your allocation, what you have allocated across different market conditions and crashes and peaks and so on, right? And that's what we are trying to convey, that have a good allocation strategy, invest in core strategies, boost your performance by taking exposure to thematic or growth vector investments. And uh, there is one question from Vikas Mishra is saying, not having a stop loss exposure is not exposing investor to risk in case of market correction. So I think that's a very trading oriented. I think we have discussed about this, but I think let's hear from you.
Yeah, so that's stop loss is absolutely a trading concept, and it's important when you're doing margin trading or trading on leverage or things like FNO, etc. There it matters, because once it starts going down, and if it breaches some number, then you end up owing a lot of money. Secondly, as a trader, and secondly, the broker is going to force your portfolio to be sold off at some point, okay, unless you are putting up all the margin required, right? So on a very short term basis, you are at the risk of your portfolio getting sold off without your control. And so it's better that you book the stop loss and exit before that happens in a controlled manner. But here we are talking long term investments. Long term investments on small case, it doesn't make sense to do stop loss. The investment philosophy, scientific investing itself says that you are getting a chance to invest when market is wrong. When market is down and it's wrong is when you get a chance to make a lot of alpha, right? Make a lot of high returns. So now let's say you are holding a position and then market goes down temporarily. It's actually time to add more, assuming you have the risk appetite, you have more capital, etc. If you don't have, and you are putting all of your capital at risk here, and that's why you're getting worried, then I think the capital allocation itself is wrong. Right? I mean, if I have 100 rupees and I put all of them in equity and probably in one or two small cases, now definitely I'm worried, because that's all of my money. And then when it goes down, I'm worried, but then that's the wrong way of allocating in the first place, especially if I have only that much capital. Now, let's say I'm a young person employed and I have huge salary cash flows or some other income coming in, then even if 100% of my portfolio is in equities and there is risk of equity markets going down, or even if there is not probability, but there is some chance, right? Even if it's low probability that it goes down, why should it matter? In fact, it's a chance to add more, because next 10, 20 years or even 30 years, I'm going to be investing more and more. But if I'm a retired person with my limited corpus and all of that is in equity, then it's a wrong allocation in the first place, probably, right? Because and then you cannot go in and out by doing this. Rather, you should have defined that maybe I want 50% equities or 70%. You could have, as a retired person, even 80% or more equities. That's fine. That depends on a lot of analysis of what your situation is. But then you do know that it will keep going up and down, and that should not bother you. But just like the chance of it going down, there is chance of it significantly going up. And if you exit, you're losing that. Okay. So again, you are neither in the market to save a downside or in the market for greed to gain on the upside. You are there to make a consistent long-term gain on your portfolio while accepting the fluctuations in the meantime. I hope I'm clear.
Sure, sure. I hope so. So the second follow-up question, Vikas, I will answer that. It's the upper limit. I think there are a couple of questions on that. So upper limit for any allocation to like a growth vector or a thematic allocation is what we see typically is something like a 5 to 10% of your equity investment. Let's say if you're putting 100 rupees into equity is around 50%, 50 rupees can go into like a core allocation. The remaining 50% you should divide across, let's say, at least 4 to 5 different kinds of growth vectors. So your basic allocation comes to something like a 10% to a particular thematic like a Bharat defense, right? So just because something has gone up and has continued to gone up significantly, I want to put 50% of my equity investment into that so that I'm a very aggressive investor and I am a risk taker and I want to capture that growth. That is something speculative in nature and we don't support that. We recommend like a upper cap. So that's where maybe that question is coming, that there is a upper cap mentioned in certain small cases. The idea is that obviously you can invest more, but that's based on like a model allocation and a model client profile that we typically see from various clients that we have on the portfolio. That's the number we have put, right? So some will restrict you to say that okay, up to 5 lakh you can invest here, right? Assuming that there is a typical client who has to allocate 50 lakh or 1 CR into equities, and he has allocated sufficiently on the core portfolios. Now these are various different thematic investment opportunities that he has. So if you're putting like 5 lakh, 10 lakh rupees into these strategies, that should be like a natural upper limit for him. But if you have a much bigger portfolio, you want to allocate more, then there is no restrictions per se. But this is more of a recommended upper limit in nature. But definitely based on your risk profile, this is strongly recommended that you don't go, let's say, more than 20% in a thematic investment opportunity, so that you can maintain you can manage the risk management is not stop loss, but the allocation level and what you are allocating to, what the philosophy is, and what kind of portfolios that you are taking exposure to. I think our approach is that approach to manage risk rather than looking at the stop loss kind of a scenario. Because when we are buying something, we strongly believe and have a good analytical basis to estimate that it is mispriced, it is undervalued. That's where the chunk of expected return going to come from. And if it is falling further, unless there is deterioration and significant deterioration in the fundamentals of the company, which again is something can be evaluated analytically, and then there is nothing more, right? If it is falling, then you just have to buy more. So that's how we look at, rather selling at a particular loss. So I think we are about to, we have completed our allocated time, because maybe just some concluding thoughts, and then we can end this session.
Yeah, so very, very clearly, I would like to reinforce that no way we are at a bubble peak or anything like that. Okay, neither the valuations, the Nifty valuations themselves suggest that, right? That we are at a bubble peak. Secondly, so it is time to, ideally, for people who can take the risk, to be in the market on the portion in which they can take risk, right, on their equity allocation. Yes, you could take allocation the way you want, but we like our own Omniscience portfolios, right? And we would do it on a 50% or 40 to 60% in the core portfolios, and remaining divided in 4 to 5 different growth vectors, right? This is how I would allocate. I would not be looking at the ups and downs of the market. If there are some opportunities in next few months, I would be taking advantage of those by adding money if I had money. So this is how we think about allocation. And personally, I don't have any mutual funds, so I have allocated all of my money using this our own Omniscience portfolios. and including my mother's portfolio, right? Who's more than 75 years. So I've put nearly 75 years old, and I put all the money in our own Omniscience portfolios. I think it's reasonably risk managed and highly diversified.
Yes. So great, Vikas. I think from my side again, one normal confusion that people have, especially in the context of the all-time high, that I want to wait and see some correction and then allocate. And typically, we have this saying that more money is lost waiting for a correction than in a correction. So while the fundamentally things are looking bright and the valuations are attractive, I think there's no point. Having said that, obviously it is absolutely true that markets can fall tomorrow for whatever
Of course, any reason.
so it's extremely difficult. Obviously, if you feel a lot jittery in terms of putting any fresh money on the block, then you can tranche it. But even then, it should be like a well-defined strategy that I'm going to deploy over the next 3 months or next 10 weeks or or 6 months. And what is the kind of size of these tranches? Because what typically happens is that let's say there is some negative news that comes in and markets start falling, then how do you play that, right? Where do you start allocating? Now, do you allocate after market is 3% down, or it is 1.5% down, or it is 5% down? And what happens if, let's say, it comes down 3% and then you were waiting that it'll go further and then it goes up again, right? And you miss the whole opportunity, and it goes up so much that you actually have missed the opportunity to allocate at the first place itself. So it's impossible game. Don't try to play that. I think only in the hindsight it can be played precisely when you have the nifty chart in front of you and you can pinpoint that this is where you have put what kind of money. Otherwise, you feel confident about the portfolios, you feel confident about the companies, their valuations, their growth opportunities, and the way they are being managed in the portfolio. I think that's all you need to go ahead. And Vikas's mom, or my dad, who is again more than 73, he is also putting most of his capital in Omniscience strategies very, very confidently. Right.
Yeah, and from the risk point of view, I would like to point out, of course, equity markets are risky. There's no question about it. Do not look at the past performance and project that in the future. Second thing. Third, definitely don't borrow money and start investing in our small cases or anyone's small cases or any market things. And fourth, this is not a short-term thing. If you are coming into anything in Omniscience, it has to be with a minimum view of 3 to 5 years. Okay. If you are coming to play some interest rate cut in next 6 months, I shared all that information. Doesn't mean that you come into play Fed interest rate cut or RBI interest rate. That's not the way to invest. Okay. So there is no greed. Throw greed out of the market. I mean, out of your mind, and focus on capital allocation and allocating your investments properly rather than trying to chase some high returns. The returns will come to you if you do the right thing, which is exactly what we do in our scientific investing framework, right?
Absolutely. And just like as a closing thought, I thought I'll just read the most important thing, that investment in security markets are subject to market risk. Read all the related documents carefully before investing. So you have to remember this always. And thank you so much to be part of this AMA, and really had fun discussing all the concepts with Vikas and everyone. Thank you.
Thank you.